Bismillahirrahmanirrahim. Assalamualaikum warahmatullahi ta'ala wabarakatuh. My name is SUMAIYAH binti MOHAMMAD. Matrix number is 230000296. For my course, IIP 410 Sharia Principle in the Islamic Economic System, I will present my assignment titled RIBA in the Context of Loans, a comparison between conventional and Islamic economic systems. This topic lets us dive into how these two systems differ in handling loans, especially with the concept of the RIBA or interest. This issue has long been a matter of debate in both Islamic and conventional economics. Let's start with some background. RIBA refers to excessive interest or profits added to loans. In today's global markets, interest-based lending is widely accepted, especially in finance. However, in Islam, RIBA is strictly prohibited. It's seen as a form of exploitation that harms both individuals and society, contrasting with Islamic teachings that emphasize fairness and economic balance. The Islamic economic model suggests alternatives that avoid exploitation and align with the ethical principles of Sharia. Let's start with the definition of RIBA. In Islamic terms, RIBA means increase or excess, referring to unearned gains in financial transactions. Islamic scholars highlight how RIBA is seen as exploiting those who are financially vulnerable. In fact, the Quran and Hadith both prohibit RIBA, emphasizing fairness and the avoidance of exploitation. In Islamic economics, RIBA is typically divided into two types. RIBA an-nasi'ah, first, where interest is charged on delayed payments, and number two, RIBA al-fadl, which refers to unfair exchange in trading similar goods. Both types are seen as forms of injustice and are prohibited in Islam. In conventional economics, though, RIBA is treated as a fair compensation for the lender's risk and the time value of money. Interest is calculated as a percentage of the loan and is based on factors like the loan term and the borrower's creditworthiness. This practice, which accepts RIBA, is foundational to how conventional banks operate, allowing them to profit while managing lending risk. However, the system also promotes free market competition, sometimes with minimal government intervention, which can result in widening wealth gap. Let's move on. Let's look at loans in the conventional system. In conventional banking, loans operate on an interest-based system. The process includes submitting an application where borrowers provide details about their financial situation. After a credit assessment, banks set an interest rate influenced by factors like risk and market trends. Approved loans require regular payments covering both the principal and the interest. Interest rates in conventional banking vary widely, with secured loans often having lower rates due to less risk. while unsecured loans may have higher interest. This interest can become a significant burden, especially during economic downturns. High interest payments can weigh heavily on borrowers, particularly particularly if they face unstable economic conditions. In contrast, Islamic economics take a different approach to lending, entirely excluding riba. Here, loans are granted based on ethical principles, focusing on fairness and sharing both risk and profits. One important loan concept is called Hasan, a benevolence loan, where the lender offers funds without expecting profit. Borrowers are expected to repay only the principal when they are able. This approach aligns with Islamic principles of community welfare and mutual aid. Besides Qur'an Hasan, Islamic finance offers other instruments like murabaha, mudorobah, and ijarah. In murabaha, the bank sells goods at a declared profit margin, while mudorobah allows profit sharing between two parties. Ijarah or leasing enables people to use assets for a fee without the risk associated with ownership. These financial practices encourage transparency and aim to prevent the exploitation that interest-based loans can create. Comparing the two systems, we can find strengths and limitations in both. Conventional economics provide efficient resource allocation and promise innovation, allowing individuals to grow wealth through free market mechanisms. However, it can also lead to financial inequality where wealth accumulates with a select few, often leaving others behind. Islamic economics, meanwhile, focuses on social justice and a fairer distribution of wealth. By avoiding speculative practices and banning riba, Islamic finance operates within ethical boundaries. The system welfare components, such as zakat charity, redistribute, redistribute wealth from the wealthy to the less fortunate, fostering social balance. However, some critics suggest that these systems rules may reduce economic flexibility or innovation. At their core, these systems are built on different principles. Conventional economics views individuals as economic beings, driven primarily by profits and efficiency, with management theories inspired by thinkers like Karl Marx and Maslow that focus on maximizing productivity. On the other hand, Islamic economics is founded on the belief in God's sovereignty, seeing humans as custodians of earth, tasked with upholding ethical principles, social unity, and moderation in all aspects. Islam's message of justice calls for fair distribution and stability, and the ultimate goal is to earn Allah's blessing through good, honest action. In summary, we can see that the main difference between this system is India approach to interest and social responsibility. The conventional system emphasis on interest-based profits can lead to social issues like heavy debt and financial imbalance. Islamic finance, on the other hand, prioritizes fairness and mutual benefits, offering non-interest based alternatives to foster economic growth without exploitation. In conclusion, Islamic finance don't just offer an alternative, it provides a socially responsible approach to financial transactions. Practices like Hasan, Murabaha, and Mudarabah encourage economic justice and prevent financial abuse, aligning with Islam's commitment to fairness and harmony in society. So that's all from me. Thank you for your attention. Thank you for your attention. Thank you.